Hello and welcome to yet another episode of the In News series. My name is Pooja Dwivedi. Today we are going to discuss all about the marginal cost of funds-based lending rate. What is this? What is the origin of it? The recent hike and how the hike in repo rate has an impact on the MCLR. We are also going to compare the erstwhile base rate with MCLR and other important things that are related to it. Without any further delay, these are the many topics that we are going to go through step by step. First of all, let us see the news. Now, recently, there has been a 25 basis point hike in repo rate. Repo rate is the rate at which the commercial banks get loan from the RBI. When the commercial banks get loan from the RBI at a higher rate, they will also lend it to the customer at a higher rate. This is the tool to have a regulation upon liquidity. The less the consumers will go to the banks for loans, the less will be the money in the economy and the less will be the supply of the money, and hence it will have an impact on the overall inflation. This is the reason behind hiking the repo rate. Okay, and multiple lenders, due to this only, they have raised their marginal cost of fund-based lending rates by up to 15 basis point. It will result in higher equated monthly installment for the borrowers, EMI, because at MCLR only the loans such as home loans, etc. are given. So we are going to discuss that only. What is MCLR? MCLR is a rate. It is the minimum interest rate below which financial institutions cannot lend, except in certain cases. But we have to ensure that we know this. Supposedly, if there are two consumers, A and B, B and A, these two consumers are different when it comes to their outreach to the banks. Now, these two people, I am the bank, I have a good friendship with A, but not so good with B. It's a regular customer. I can give loan to A at 8% because he or she is my friend. But B is not my friend. It's a regular customer of the bank. So I am going to give this person 15% of interest rate with whatever the loan I have given. Now, what happens that if there is no transparency, what will happen? Supposedly A defaults on the loan. Even if I have given that person a lesser interest rate loan, if this person is going to default, then what will happen? Less money will be available with me to give to other consumers now. And this is the reason why MCLR was brought into force, that below this rate, you are not allowed to give loans to other people. Okay. Marginal cost of funds-based lending rate defines the process used to determine the minimum home loan rate of interest. Moving on. Now, how a hike in repo rate results in a hike in MCLR? See, because MCLR are linked with the repo rates, the repo rate goes high, the MCLR also goes high. So lenders will push up their MCLR rate. That will translate to spike in interest rate and equated monthly installments, the EMIs. However, this hike will be applicable only to floating interest rates and not fixed ones. Remember, floating, they can change, but fixed, they cannot change. MCLR will lead to an increase in loan EMIs, and this may cause increased rates of interest on loans and the EMIs that accompany the loan. Repo rate is supposedly 25%. So, because of this, the MCLR becomes 15% because these two are linked. As the repo rate has increased, that means the banks cannot get more loans from the RBI. Earlier, the banks might have gotten loan at a lower interest rate. This was done to increase liquidity in the market so that consumers can also get loans at a lower interest rate. But now, as repo rate has increased, the banks will not go to the RBI, please sir, give us loan. Then of course, they will have less money in their hands, the banks. The consumers will also not be provided loan at a very good interest rate. So it's supposedly like that. Okay. Moving on. Now, if we talk about the origin, this MCLR was introduced in 2016 by the RBI. It replaced the erstwhile base rate system, which was introduced in 2010. Okay. And MCLR versus the erstwhile base rate, this is something we have to talk about. See, earlier, the banks, because there was a lack of transparency and accountability, they could give the loans to somebody who were their friends or family. And because of that, they used to get undue advantage. Since base rate was the financial institution's internal policy, so nobody could have come and said, what are you doing? Why are you giving this amount of loan to that person at such a low interest rate? So there was no accountability. And this caused huge monetary loss because those persons used to default. Thus, RBI, because of that only, switched to external benchmark linked lending rate. Okay, this system where lending rate is linked to the benchmark rates like repo rate or the treasury bill rates. Now, renewal of credit limits and sanctioning of loans is done on the MCLR because of that only. So, once repo rate increase, as MCLR is attached to this now, so MCLR will also increase. Now, banks will have to be accountable. The objective is very same, to facilitate the implementation of the lending policy rates which are defined by the Indian Reserve Bank, because in the economic system such as India, it is important to regulate these entities to ensure that all Indian financial institutions are complying with it fully, and also to bring the much needed accountability and transparency in the functioning of these banks. Also, to pass the benefits of reduced interest rates to the customer. Once the repo rate comes down, there will be more to give to the commercial banks by the RBI, and hence there will be more to give to the consumers by the commercial banks. So this is how it works. To ensure the availability of loans to customers that is fair to both the customers as well as the lender, that is the bank over here. And it is mandatory for the banks to declare their overnight 1 month, 3 month, 6 month, 1 year and 2 year interest rate every month. Remember that. Moving on, the components of MCLR and how it is calculated. See, there are many things that have been kept into mind whenever we are calculating MCLR. First of all, it consists of marginal cost of borrowing and return on net worth. What is the return on net worth, whatever they are giving, and what is the cost of borrowing it. Negative carry on account of cash repo rate, which is the cost banks they incur to keep a reserve with themselves. Then operating costs which are incurred by the bank to give out that loan, and tenor premium, which is the higher interest that can be charged for long-term loans. So all these are included in MCLR. Now, interest rates which are offered on deposits, including saving, term and current and foreign currency deposit, these are the basis of charging MCLR. Other than that, return on net worth and borrowings mean the repo rate, short-term interest rate and long-term interest rate all. Moving on, what kind of loans will be linked to MCLR? All floating rate loans that are sanctioned from 1st April 2016 will be based on MCLR. For credit renewal as well, if you want to renew your credit, whatever you have gotten from the bank, then also it will be applicable. Floating rate loans include what? Home loans, loans against property, corporate term loan, and MCLR is relevant only to bank. That means other financing industries are not included in it, the small financial institutions. Exemptions are fixed rate home loans, car loans or personal loans, loans that fall under government schemes, and MCLR is applicable only to bank, which I have already told you. Moving on. Now, if we talk about, is MCLR a better way of regulating bank lending rates? Of course it is. See, it ensures effective transmission and application of policy rate. So it brings uniformity, transparency and accountability. Financial regulation in India is harmonized and it is not haphazard in nature. This bank is lending at that rate, that bank is lending at that rate. So it tries to be in a harmonized manner. Providing equity in the lending rates, it's not like A is getting loans at a better rate, but B is not getting it. It ensures that the benefits of the Indian Reserve Bank interest rate cuts are available to borrowers, and there is not sweeping away of profits by the lenders. And also reduction, whenever repo rates go down, there is also reduction in EMI on any loan. Okay, I hope you understood this. Thank you so much for watching. Stay updated.